Everyone, it's Nick with Us versus Herd. Thanks for joining me today. Just getting back in the rhythm here. Today we're going to be talking about the Fed. I'm going to go through some charts, kind of see what's going on here, see what the outlook is. But first, before we get into that, if you want to join our community, join our Discord, join our Facebook group, link is below in the description. Now, the Fed has been I would say a little bit unhinged. And the reason why I say that is because, and I was talking to a buddy of mine earlier today, was basically the Fed, I think, knew that we were going to have this inflation problem, right? And we keep saying, or they're in denial or something like that. But you have YouTubers like myself and other YouTubers and people that, I mean, maybe we're not that smart. I don't know. Are we smarter than Powell? I mean, I don't think so, because it's too obvious. This is too obvious. I mean, back in the pandemic, we said, hey, with all this printing of cash, we might have a problem. We're going to pay for this later. You may save the economy today, but you're going to have to pay it later. Sometime that's going to become to get paid, right? Somebody's going to come and collect that debt. And now is the time. But what was interesting to me was, for many months, I mean, we went, there's been no inflation to inflation is transitory to, oh no, now we have 8% inflation. What happened? You let 3% go by, 4%, 5%, 6%, 7%, 8% and higher. I mean, we're through the roof. I mean, cars were super high, housing. I mean, things are crazy. 40%, 50%, 100%. I'll calm down. I'm just a little heated because for a long time we've been saying, hey, this is the situation, but the guys at the top, I mean, they had to have known. They had to have known. That's all I'm saying. They had to know, because for it to get this bad, I mean, and now they're coming out the woodwork saying, oh well, high gas prices are going to be with us a long time. Inflation's going to be with us a long time. Like, what happened? Just because we're at 8% inflation, you immediately? I mean, we all saw this coming. I mean, every American has saw this coming. But you're saying the Fed didn't see this coming? Come on. But let's get into it. Where I see the market, what's happening right now. Let me know in the comments if you like the video so far. Hit the like button. Definitely appreciate it. I want to know. I mean, do you think the Fed saw it? I definitely think they do. Maybe they were in denial, but I mean, I may not be the smartest guy in the room, but I mean, it was pretty obvious. And it was obvious to a lot of Americans, right? And now they want to blame it on the war. They want to blame it on it. Listen, doesn't matter. It was here. It was always here. And it's going to get worse, okay? And now we had the Fed. The Fed minutes came out today saying they want to shrink the balance sheet by $95 billion a month. They attempted to do this back in 2018, failed, and Janet Yellen said, and we'll look at the chart too. Janet Yellen said, "Oh, it was a mistake. We shouldn't have done that." Right now, the Fed is propping up the market, and also corporate buybacks are propping up the market. Once those are through, I mean, people think we're down bad already, but you haven't seen anything yet. I'm not trying to scare you. I just want you to be prepared. That's what we do in Us versus Herd. We don't want to scare, but be prepared. Okay? So the Fed officials reached consensus at their March meeting that they would begin reducing the central bank balance sheet by $95 billion a month, likely beginning in May. So May is 3 weeks away, 4 weeks away here. I mean, we might be seeing, it might get dicey. So just be careful. If you're like, oh yeah, I really want to buy that long-term stock, if I think it found the bottom, maybe just wait another month. You never know, right? There are also strong indications that half percentage point or 50 basis point interest rates increases are ahead. So we just had a 25 basis interest rate increase, and they're looking for a 50 basis point interest rate increase in here. Okay, it said, officials generally agreed that a maximum of $60 billion in treasuries and $35 billion in mortgage-backed securities would be allowed to roll off the balance sheet, phased in over 3 months and likely to start in May. So for May, for the next 3 months, that's their goal. That total will be about double the rate of the last effort from 2017 to 2019 and represent part of a historic switch from an ultra-easy monetary policy. Now, I mean, I'll be honest with you, I don't think that's enough. When the Fed balance sheet is like $9 trillion, I don't think $95 billion for a couple months. I mean, it's going to cause some pain, but for the balance sheet, to reduce the balance sheet, it's not gonna really do anything, right? Now, because of this, interest rates increasing. I mean, the stock market's moving lower, but things are getting dramatically worse, right? The 30-year mortgage crossed 5%, right? So, what does that mean? It means people cannot buy the same house for the same price because the price went up. It's like even if the the price stayed the same of the house, the loan amount is going to be higher. Your monthly payment is going to be higher. And at what point? The question is, at what point does it get to be too much for that American to be able to afford that house, to be able to buy a house, right? So this is going to slow things down. And right now, the Fed right now, they're running scared, and they're saying, hey, we're going to raise interest rates basically until inflation goes away. So we've had historically low interest rates. Some were getting like 2.5% a little bit ago, 3%. I mean, that's historically very, very low. Now, the 30-year mortgage just crossed 5%. It's the first time it has crossed that threshold since 2011. It stood at 3.38% 1 year ago. So 1 year ago, you're at like a little bit above 3.25%. Now you're over 5% on a 30-year mortgage. And what's that doing? Obviously, refinancing is going way down, right? Mortgage applications demand went down 40% from a year ago. Applications to refinance a home, which have been falling steadily for months, dropped another 10% to week to week. Mortgage applications to purchase a home fell 3% and were 9% lower than the same week 1 year ago. So the question is, if you didn't lock in your rate, right? If you didn't lock in your rate and you're looking for a house, you might not want to be looking for a house anymore. You might be looking for a rental. If you bought a house and you have a low rate, you may not be looking to move for quite a long time, because it looks like, things are not going to be, at least for the next couple of years, interest rates are not going to be coming down. I mean, I do think that eventually the Fed is going to ease their monetary policy once inflation gets under control, and, stocks that kind of hit a bottom, they'll start to ease up so we can climb our way back up. But until then, I mean, we're kind of in the midst of it, and everyone's like, I don't know how much more we could take. And a few weeks ago, everyone's like, oh yeah, we're rallying, we're going to all-time highs, recover. But I mean, it's just a lot of things are out of our control. We're in a bad situation. Inflation's bad. Fed is tapering. We're gonna be having some issues here. And the charts basically say it all, right? So here's the Nasdaq. One of the things I trade every day, Nasdaq futures. I'll cover S&P and Dow as well. But this is the situation, right? At the start of the year, nothing but down, right? Here's the start of the year 2021, and we've been going nothing but down. We broke below the purple line here is the 200-day moving average. We broke below the 200-day moving average on January 20th, and we just kept going down. Everyone's like, please stop. And then, as soon as we get a little bit up, bulls again are saying, hey, we're going back to all-time highs. We did our little dip, because that's what we're used to. We're used to seeing, these dips get bought. And this is going to be the first time in a very, very long time that dips are not getting bought. And if they are getting bought, they're getting sold off, right? And just the area that I've been talking about in our Discord and our Facebook group for a long time is essentially the 200-day has been resistance, and everyone was like, oh, this time is different. Just a couple of days ago, oh, this time is different. I mean, it had a lot of strength. Don't get me wrong. We ran for a solid almost 3 weeks. Everything ran for solid 3 weeks. And what happened? We went above the 200-day, and we are getting smoked right now. So now we've been rejected here once, twice, 3 times, 4 times. How many times are it going to take? I mean, are we going to bounce here? I don't know. I mean, I'm just taking it a day at a time right now, but I'm just letting you know, right? It doesn't look good. It doesn't look good. S&P was doing the best out of everything. Everyone was like, oh yeah, SPY is doing well. SPY is doing great. Yeah, it was for a couple weeks. And now today it closed back below the 200-day moving average. You gotta be careful. Like what I'm looking at is price action. I'm not trying to look at, what's going to happen. I'm saying what's happening right now and what my sentiment should be. And my sentiment right now is take it a day at a time. I used to swing trade a lot. I've turned into a massive day trader, and that's pretty much what I do, because I honestly don't know how bad it's going to get. I hope it doesn't get too bad, but you never know. Like, I'm not a bear. I'm typically bullish, but the price is the price. You know, it is what it is. I mean, you can't. The thing is, as a trader, you can't get locked into a mentality like, oh yeah, I'm going to buy the dip, buy the dip. If buying the dip is your strategy, you don't have a strategy. You're smoked. You're obliterated. You're done. You're done. I mean, sure, you could buy the pain, but for how long is that going to work? You know, you could have bought this pain, but you don't know when it was going to stop dipping, right? You don't know. We don't know. I mean, we could just bounce here tomorrow, go to all-time highs, sure, and I'll look like an idiot. Is what it is. I mean, I want to look like an idiot because, I mean, that means we're all making money. We're all making money. Everyone's 401ks, net worth's going up. Everything's going up, right? I hope that's the case. But right now, price action is telling me it's not the case. And here, close back below. We went way high on the S&P, way above the 200-day moving average. Things were looking okay. Everyone's like, dodge a bullet. But now we just got smoked. Last 2 days have been brutal on the S&P 500. I mean, just brutal. I mean, everything is getting Dow. That was very similar to Nasdaq in a ways, where it's been using this as resistance to 200-day moving average. And sure, I mean, pretty much the same chart, but it did coast back in here back in early February above the 200-day moving average. Kind of did a double top over here and just, you know, got smoked again at the 200-day. Now, range is getting a little tight, but my thing is, just, you know, you want to be careful. The 200-day moving average, I mean, we're closing below that, and stocks are starting to close below that. I mean, you want to be cautious. Everyone's like, oh, this is a buy opportunity, but you don't know how far it's going to dip. And then with the Fed is tightening things, reducing their balance sheet. You know, I'm just saying be careful. But the Fed right now, the Fed used to be your friend. Now the Fed is doing whatever it takes to control inflation, because inflation could topple a government, right? Inflation could get out of control. I mean, you look at Venezuela, you look at all of these, because once inflation gets out of control, people get out of control. They can't afford things. People go hungry, uprisings, right? They don't want that. The government does not want that, which is, you know, for my first point is, how come they didn't see this? Maybe they did see this. I think they did. Why would they want that? Why would they want to get this bad? Do they want a great reset? I don't know. I mean, that's kind of tinfoil hat stuff right now, but I'm just, you know, as a trader, kind of looking ahead, just taking a day at a time. This is where we're at today. We had a massive rally. We could have broke to all the highs. We did not. Now we're closing below the 200-day moving average. Interest rates are going up. Quantitative tightening. The Fed is not your friend anymore. Be careful. Jay Powell is not going to be printing. All right. So the main thing that I'm concerned about is layoffs. Once the layoffs start happening, we're going to have trouble. If layoffs, I hope, I mean, unemployment's super low right now. I hope it stays that way. But once layoffs start happening, starts coming for corporate profits, I mean, starting to reduce balance sheets, I mean, it's going to be across the board. And once companies start, you know, their buyback programs, they stop that, I mean, it's going to get interesting. So all I can say is, hey, watch to the end, comment, watch to the end. As always, stay safe, stay green. It's also for sure.